We all know Warren Buffett and Michael Burry as savvy investors, and both of them have achieved extraordinary success. Their investing strategies have made them billions. Apparently, both Burry and Buffett focus on and follow Benjamin Graham's method of value investing. But both of them have slightly different styles.
Who was going to listen to John Paulson in 2005 or 2006 from Michael Burry? It didn't mean anything. Look at me. I was wrong on it too.
Today, we will delve into the investment strategies of these two investors and the key factors that have driven their success. Warren Buffett, the Sage of Omaha. Warren Buffett, often called the Oracle of Omaha, is renowned for his disciplined approach to value investing. His strategy is deeply rooted in the teachings of Benjamin Graham, the father of value investing. Buffett's method revolves around identifying undervalued companies with strong fundamentals, purchasing their stocks, and holding them for the long term. This approach involves many of his core principles. Number 1. Intrinsic value. Buffett emphasizes the importance of intrinsic value, which is the true worth of a company based on its fundamentals. He believes that the market often misprices stocks in the short term, but over the long term, prices tend to reflect the intrinsic value of a stock. For example, Buffett's investment in Coca-Cola in the late 1980s was based on his assessment that the company's brand strength and global reach were undervalued by the market. Over the years, Coca-Cola's stock has provided substantial returns, proving his analysis right. Number 2. Economic moats. One of Buffett's key criteria for investment is the presence of an economic moat, a sustainable competitive advantage that protects a company from competitors. This could be in the form of brand strength, patents, network effects, or cost advantages. An example of this is in Buffett's investment in American Express. After the salad oil scandal of the 1960s, American Express stock plummeted, but Buffett recognized the strength of its brand and customer loyalty as a moat that would ensure its recovery. His investment paid off handsomely as American Express regained its position as a financial services leader.
American Express had a very special position in people's mind about financial integrity over the years and ubiquity of acceptance. When the banks closed in the early 30s, American Express traveler's checks actually substituted to some extent for bank activity during that period. When the credit card came around, originally American Express went into the credit card because they thought they were going to get killed on traveler's checks. And they thought it was going to be a substitute, and therefore they had to go into it. It was a defensive move. It came about because a fellow named Ralph Schneider and Al Bloomingdale and a couple of people came up with the Diners Club idea. And the Diners Club idea was sweeping initially New York and then the country in the mid-50s. And American Express got very worried because they thought, people are going to use these cards. People were going to use these cards instead of traveler's checks. So they backed into the credit card business. But American Express went in and they started charging more than Diners Club for the card. And they kept taking market share away. Well, that is a great position to be in people's minds, where they are willing, when faced with a choice, they're willing to go with the newer product at a higher price and leave behind the entrenched product. And it just showed the power of American Express. That told you what was in people's minds. It's why I bought into the stock in 1964. We bought 5% of the company for a huge investment at the time for us. I was only managing $20 million at the time.
Number 3. Long-term perspective. Buffett's famous holding period is forever. He looks for businesses that have enduring qualities that can generate consistent earnings over the long term. His investment in Apple is a testament to this approach. Despite initial skepticism from some quarters, Buffett saw Apple's strong brand, customer loyalty, and innovative capacity as long-term strengths. Since his initial purchase in 2016, Apple stock has surged, reflecting Apple's continued success. Number 4. Management quality. Buffett places significant emphasis on the quality of a company's management. He looks for leaders who are capable, honest, and shareholder-oriented. His long-term investment in Berkshire Hathaway, his own company, exemplifies this belief. By acquiring well-managed companies like BNSF Railway and Geico under the Berkshire umbrella, Buffett has ensured sustained growth driven by competent management. Now, let's see Michael Burry's approach. Michael Burry, on the other hand, is known as a contrarian investor, and he is best known for predicting and profiting from the subprime mortgage crisis of 2007 to 2008. His story was popularized by the book and film The Big Short. Burry's approach also follows Benjamin Graham and focuses on finding value where others see none.
I look for value wherever it can be found.
His contrarian approach involves intensive research and a deep understanding of market dynamics. Number 1. Contrarian investing. Burry's investment strategy is fundamentally contrarian. He looks for opportunities where the market consensus is wrong. His bet against the housing market in the mid-2000s is a prime example. While most investors believed in the continued rise of housing prices, Burry's detailed analysis of mortgage-backed securities led him to bet against them by purchasing credit default swaps. This contrarian strategy resulted in massive profits when the housing market collapsed. If you want to know how exactly Burry made millions during the 2008 crisis, then check out this playlist on the channel. Number 2. Deep research. Burry is known for his exhaustive research. He dives deeply into financial statements, market trends, and economic indicators to uncover hidden risks or opportunities. His early investment in GameStop, based on a thorough analysis of the company's fundamentals and market position, showcases this aspect of his strategy. Burry saw potential in GameStop's strong brand and significant short interest, which led to a highly profitable position when the stock surged in early 2021. Number 3. Risk management. A critical component of Burry's strategy is risk management. He used financial instruments such as credit default swaps during the 2008 crisis. This careful consideration of risk enabled him to make bold bets with a safety net in place. During the financial crisis, his use of credit default swaps to bet against subprime mortgages minimized potential losses while maximizing gains. We have explained everything about credit default swaps and how they work in this video. Make sure you watch it. Number 4. Focus on specific themes. Burry often focuses on specific investment themes based on macroeconomic trends. For instance, after the financial crisis, he invested heavily in water and agricultural land, anticipating future scarcity and rising demand. This approach allows him to capitalize on long-term trends that are not yet fully appreciated by the market. His investment in water rights and farmland reflects his approach to resource scarcity. While Buffett and Burry have different approaches, both have achieved remarkable success. Comparing the main similarities in their strategies provides valuable insights for investors. Number 1. Time horizon. Buffett's strategy is inherently long-term, focusing on companies that can perform well over decades. Burry's approach, while also long-term in its own way, often involves identifying and capitalizing on specific market inefficiencies that may not last as long. For Buffett, the time horizon is decades. For Burry, the time horizon is 5 to 6 years. Number 2. Research intensity. Both investors emphasize the importance of research, but their methods differ. Buffett looks at the broader picture, focusing on a company's business model, management, and competitive advantages. Burry also dives deeply into such details, but his focus is more on finding inefficiencies in the market or stock prices. Number 3. Market perception. Buffett tends to invest in well-established companies with proven track records, often going against short-term market sentiment but aligning with long-term fundamentals. Burry, however, frequently takes positions that are highly contrarian, betting on significant market shifts that others do not foresee.
My activities in Sign Capital, I thought of myself as a value investor. Soon, my attention was caught by this growing importance of the housing sector. The amount and type of leverage, the generations-old acceptance and assumption that prices always went up, and the very broad societal participation, greater than 60% owning home. This all called out to me. This was not just a case where a few early adopters made a lot of money or a few venture capitalists acted badly. The entire economy depended on home price appreciation. Now, in predicting when and how the collapse would occur, my focus was again on the actions of our government and the response of the private sector.
Number 4. Risk tolerance. Buffett's investments are generally seen as more conservative, focusing on companies with stable earnings and strong competitive positions. Burry, while also careful about risk, often takes on higher risk positions that can yield substantial returns if his strategy plays out. Let's see some examples of Buffett's investments. Washington Post. In 1973, Buffett bought shares of the Washington Post Company for about $11 million. He believed that the company was undervalued and that it had significant long-term potential. his investment grew more than 100 times over the years. The Washington Post company eventually sold its newspaper division and transformed into Graham Holdings, with diverse business interests including education, television broadcasting, and cable television. The value of Buffett's investment increased to over $1 billion.
The Washington Post company had gone public in 1971, right about the Pentagon Papers time. But in 73, the Nixon administration, they were challenging the licenses of 2 of the Florida television stations the Post owned. So the stock went from 37 down to 16. Now at 16, there were about 5 million shares outstanding. So the whole Washington Post company was selling for $80 million. And that included the newspaper, 4 big TV stations, Newsweek, and some other assets, and no debt to speak of. So the Washington Post company, which was intrinsically worth $400 or $500 million, was selling for about 80 million in the market. We bought most of our stock at about the equivalent of 100 million in the market, and it was ridiculous. I mean, you had a business that unquestionably was worth 4 or 5 times what it was selling for.
Bank of America. In 2011, during the aftermath of the financial crisis, Buffett made a bold investment in Bank of America. He invested $5 billion in preferred shares, which came with warrants to buy 700 million common shares at a price of $7.14 per share. When Bank of America's stock recovered, Buffett exercised these warrants, and the value of Berkshire's stake grew to over $30 billion, making it one of Buffett's most lucrative investments. Let's see some of Burry's investments. MGM Resorts International. During the COVID-19 pandemic, Burry took a position in MGM Resorts International, betting on the recovery of the travel and leisure sector. He recognized that the pandemic-driven downturn created a buying opportunity in companies poised to rebound once normalcy returned. As the economy began to recover and travel restrictions eased, the value of MGM Resorts stock increased, validating Burry's investment thesis. You can clearly see how Burry took advantage of short movements and panic in the market. Overall, Buffett's value-oriented, long-term approach is grounded in patience, discipline, and a keen eye for quality. Burry's contrarian, research-intensive strategy is driven by a willingness to go against the market with a deep understanding of market mechanics. Both of them focus on the value of the stock that no one has realized in the market. The only lesson you should take from this video is to find undervalued stocks that have great potential to grow over the years. That is a sure-shot way to create wealth over time. We hope you liked this video, and if you want to learn more about Michael Burry and how he shorted the housing market in 2008, then subscribe and check out this playlist.